Let's take a minute to talk about the 2021 stock market crash. And this is all not doom and gloom like you might think. So we're going to be going over exactly what to do if this stock market crash happens, what you can do right now, and what I am doing to prepare for this. First things first, the most important thing of all, my name is Tyler, and I do want to share a statistic with you guys. They say that we have a 0.00001% less likelihood for every like button that is smashed, tickle, tap, touch to see a stock market crash or correction in the next 12 months. So do your part, hit that like button, and with that, let's get into it. The stock market as a whole looks like it is on a rocket ship straight to the moon, especially if we are on the max chart like we are right now. And if we pull out the 5-year chart, we can see we hit our major low during the COVID-19 sell-off, March 20th, 2020 at $2,304.92. And currently we sit at $4,164.66, going up almost 100% in the past 12 months. Now, this is absolutely meteoric rise, and we are overdue for a major sell-off. Whether that's 10% or 30%, that is the part we do not know. One of the ways you guys can protect yourself, especially for somebody that has margin, really it only applies to somebody that has margin, but is to sell some stock, not all your stock, in stocks that you are up a lot on. Say you are up 100% on Tesla, and I'm just going to use Tesla as an example. I don't think you should sell Tesla. It's a great company to hold for a very long time. But if worst case scenario, you have a ton of margin, you're up 500% on Tesla, I think it's much better to sell a little bit of Tesla to reduce some margin rather than sell a stock you're down 30 or 50% on, just in order to prevent a margin call or a potential margin call and have some cash on hand to be able to buy the dip. And right now, it is certain that we're going to have a crash or a correction. Now, the time frame between this, if it'll happen now or later, is yet to be determined, but it is going to happen, and I want to be very clear about this so you guys are prepared to do what you need to do to protect yourself when it happens. Now, the next thing you guys can do, and this is pretty much similar to the first thing, but it's just hoard cash. If you have extra cash, you do monthly deposits, whatever your amount is, and I do recommend you guys do monthly deposits. Set a set amount, deposit it each day on every single month, but in this circumstance, I don't think you should try to time the market, but right now when it is so frothy, you could say, let's do half of my monthly deposit. Let's keep the other half and wait until something happens, because like I said, something is going to happen and you want to be able to go shopping. So if you have abundant cash in hand, your bank account looks real nice, then this is probably not a concern to you. Spend the whole monthly deposit, whatever the case is. But if you don't, and you are selling some stocks that you were up on and you have your monthly deposit, me personally, am keeping that monthly deposit and probably the next couple monthly deposits, just waiting on the sideline if we don't get a correction in that time. One of the worst things you can do right now is throw all of your money in at one time. Now, if you want to throw your money into your brokerage account, your Robinhood, Webull, whatever you use, M1 Finance, SoFi, whatever you use, that's not a bad decision to have the cash ready to go. But as far as going all out and buying stocks right now, I just don't see that as a good game plan. Maybe I am wrong. Maybe this video will totally blow up in my face and the S&P 500 goes up another 100%, but I just don't think that's going to be the case. So I'm going to stick my neck out on the line here to give you guys that information and basically share what I am doing. Don't listen to what I am doing. Go with your gut. That's one thing I have learned in life, not just investing, is go with your gut. 9 times out of 10, your gut will tell you what to do. Now, if your gut is telling you there is a stock market crash or correction coming, you can buy insurance on your largest positions, and that is simply just buying puts. So if you have Tesla at $700 a share, you buy a $690 put, you are essentially protected from a loss anything under $690 minus what you paid for the contract. So if you bought a contract for $500, you are protected anything out from $685 and lower, you will not lose any more money. Say you only have 100 shares of Tesla. Now, I'm not going to go into that too much, but that is the general concept of it. If Tesla were to tank 50%, your portfolio would not go down all that much because you have this insurance on your positions. Much the same way as you buy home insurance or car insurance, this is only for when you need it, when you need the protection, and hopefully it doesn't come, right? So with that being said, you don't want to overpay insurance on your car or your house. So I would advise you guys not to do the same when buying puts. And that is where you can really lose a lot of money. If nothing ever happens, you will lose all that money. So like I said, I'm not a financial advisor. I'm not giving you guys any recommendations, financial advice, none of that. But don't overpay for your insurance. That is a rule of life. So if you guys are anything like me that likes an all-around insurance play, you don't exactly want to hedge every single big position in your portfolio, but you want the opportunity to, like I said, have insurance to recoup any losses you would get without actually selling much shares, then the UVXY might be for you. And this is a volatility tracking index, and basically what it does, it goes up when the stock market goes down. Now there's other factors that go into this, like how many people are buying options in this, how many people are actually buying the shares in this, and how fast it goes up or how fast it goes down. So theoretically, the higher the stock market goes, the lower this continues to go. But once the stock market starts to go down, like I said, it starts to go up. So if we take it back to 2018, when we seen our first major correction that most of you guys, some of you guys, I won't say most of you guys, but a good portion of you guys probably experienced just like I did. The UVXY went from about $5 at its low point right before this actually happened, in between $8 and $5 before this happened, and started to shoot up, and its high was at about $82. So if you had options in this, and keep in mind the UVXY is fairly cheap compared to just buying insurance on your whole portfolio as a whole, the options can be cheaper in UVXY. And this is really good for a gray swan or a black swan event that you don't necessarily see coming. Like right now would be a good time to buy options in this because it is cheap, and if it moves a lot, you can make a lot of money. Like take a look right here in March, January, February, when we knew coronavirus was around and we knew this could possibly be a big deal. It was starting to come out in China. The UVXY was, about $10 to $15 in between that price range in February, guys. And this is when we kind of knew something was going on, and it shot all the way up to about $91, and even was a little bit higher than that for a brief period. But you get the point. You can play this if you're early to it and make a lot of money. Now, with that being said, if it does not happen in your specific time frame, like I said previously with just insurance as a whole, you will lose that money. Like I currently have a UVXY $5.50 call expiring May 21st. I bought one of them for $64, and this was just like a, hey, if something happens, I know the market's overstretched. If something happens, then I will make a lot of money off this. If nothing happens, then I will lose the money and my portfolio will make up the difference, right? I've been selling covered calls, cash secured puts. I've been doing a lot of other strategies, credit spreads, debit spreads, a lot of other strategies. So I'm not too concerned about the $64. Worst comes to worst. But that is why you keep it small, because these things do happen. I am down 51%, down $33. Currently has a market value of $31 per share, and this is for a $5.50 call. If you guys know about options, then you'll completely understand this. But if, let's say, the UVXY went to $90, this contract would be worth $8,500 for just the one that costs $64. So you can make massive returns, and this is a great way to hedge your position. Now, I never would tell you guys to buy shares in this because it is designed by nature, by the stock market, by everybody who made this volatility index, is to go down. The stock market is designed to go up, and this is designed to go down over time with spikes along the way. Also, this next strategy is one of my all-time favorites, and I've been implementing this a lot over the past couple of days. It has no risk, whatsoever if you do this right, and it frees up cash so you can go shopping once the drop actually comes. And if a drop never comes, well, then you're still in luck because it's a risk-free trade. And what kind of insurance do you get that is no risk or does not cost you any money? So with that being said, this is called selling a covered call, and we're going to get into it right now. Now, I am only going to demonstrate what selling a covered call is on CCIV. I did this on a lot of stocks. Basically everything besides NEO, I do believe. Maybe one or two other stocks I have 100 shares in. But I didn't do it on NEO because earnings was coming up and I didn't know if they were going to be good or bad. So I didn't want to have to sell my shares. But basically the key here is, so when you sell a cover call, basically whatever, you go to your date, and we all know this. If you're an options trader, you really know this. But when you sell a cover call, you have to own 100 shares of the stock, and I own 100 shares of CCIV at $25 per share. So when you come to the option chain, click sell. If you're on Robinhood, it'll be exactly the same way. Sell, and then basically you just have to sell something more expensive than your average cost. So if, like, my average cost is $23, so I could have sold this one for $23. I would have collected more premium because I'm up about 50% on this since I did it about 2 days ago. But you're basically agreeing to sell your shares at this strike price. If, in this case, CCIV closes above $25, then I will have to sell 100 shares at $25. And if you agree to sell them higher than the price you paid for the shares, then it's a no risk trade. So in this case, I did this. I sold the $25 call. I sold it for $65. When did I sell this? Did I do this today? No, I did this yesterday for $65. It is currently worth $31, so I am up 52% or $34 on this trade. And that just frees up money, because when you sell a cover call, you collect that money right up front. You collect it the second you do it. If you were to come here, sell, make sure you're on sell, because I've actually done this on desktop where you mean to sell a cover call, but you buy a call. Sell, click on one. It says short call, total credit 28 cents is $28. If you guys trade options, you already know that. Whatever you get filled, you can do it on the ask. So you get filled right away, which is 26, or you can try to get filled in the middle, which is 28. Boom. And collateral, 50 shares of CCIV, because I only have 50 extra right now, because I sold a cash secured put at $20 a share, which I don't think that'll get assigned, but who knows, it might. If it does, whatever, I still average down on my position. But essentially, you would collect this premium, this $28, and that would be yours to keep no matter what. So really, you'd be selling your shares, if you did this right now at $25 for the 31, you'd really be selling your shares for $25, 31 cents a piece, because you collect this money right up front. And if CCIV never gets to $25 by May 21st, which I don't think it will, that's why I did this, you will keep the premium that you collected. In my case, $65 is mine to keep, and no risk on the trade whatsoever. So as long as you do that right, you're good. Now, if you try to get greedy, and my average cost is $23, you try to get greedy and sell something that's like $21 for 82 cents. Well, essentially, with adding the 82 cents and the $21, you would be selling these shares for $21.82. So you would be losing money on this trade if you got assigned just because you were trying to get greedy and get a couple extra dollars. Not worth it. Just let me tell you, firsthand experience, it is not worth it at all to do that. So I think the best way to protect yourself, and what I've personally been doing, is to implement all of these strategies, not just one, but all of them on a small scale. There's no reason to go crazy on this. Even $200 to $300 can make you a lot of money in the event the market does crash and you are early to it. Now, if you are spending anything over like 0.5% of your portfolio's value on insuring it, that is a no-go. And even 0.5% might be too extreme depending who you are, but it really depends how your certainty of an crash or correction coming. How likely do you think this is going to be? I think it's pretty likely, but I don't have a time period. So I spent about $200 to $250 on insurance that is going to last until September, October, and November. I don't think I have any that expires in December, but between those 3 months, I do think we will see some kind of correction over the summer, and that is what I am expecting. So that's what I'm going to put my money on, but it's a very small amount. It's about 0.5%. Anything over that is way too much to protect your portfolio, and quite frankly, it's an overkill. And if you lose that money, then you're not going to be too happy with yourself. I don't even think it's 0.5%. I think mine's 0.25%. So with that being said, play it small, play it cool. No need to panic here. Hoard cash, wait for the dip. It is coming. Don't get too jumpy. I will see you guys later. I hope this video helps some of you guys. Peace out.